Hello, fellow Rebel Capitals. Hope you're well. So we have the big Fed rate cut decision. It is upon us in just a mere 25 minutes or so. This is going to be huge. The biggest Fed rate decision possibly over the last 2 decades. We'll have to see how this plays out and how the market responds. And what's very interesting about this Fed rate decision is it's not unanimous. So you guys know from watching my videos, whenever we talk about this stuff, usually there's like a 90% probability that the market attaches to the Fed keeping rates the same or raising by 25 basis points or lowering by 25 basis. My point is it's typically unanimous throughout the market. But this one is fascinating because not only is it 50-50, but it's been changing dramatically. Let me show you what I'm referring to. I got to switch up the screen share. Josh, remind me to go back to the CME before we go live with the announcement. By the way, guys, they're going to make that announcement, like I said, 24 minutes from right now. So we're going to go over some charts. We're going to go over some other commentary that will help us better understand the ramifications of a 25 or a 50 based on what market expectations are. So let's go first and foremost. What I wanted to do is shoot over to CNBC. Now, I heard this interview just when I was getting lunch, and what I thought was most interesting was the fact they actually had a gal on from Citi. Her name is Veronica Clark, and you can kind of tell throughout this entire interview that she's more of like a rebel capitalist. And what I mean by that, other than the way she talks, I wish if she, Veronica, if you're listening, you got to stop the talking like you're always asking a question. We'll get into that in a moment. But other than that, you can tell that she's like, well, I don't know. We're kind of leaning toward a recession. Well, I don't know, the yield curve. And then the talking head keeps saying, well, this is absolutely nothing like the GFC. This is nothing like the dot-com bust. And it's the back and forth is incredible. But Veronica thinks there's going to be 125 basis points of cuts between now and the end of the year, which compared to most of her peers is extremely dovish. What she's basically saying is she expects a recession, but she's not allowed to come out and say that she's expecting a hard landing. Let's get right into this interview, and you'll see exactly what I'm referring to. So, Josh, you can see this.
Sure. About
audio's good.
Yes.
Okay.
Her call from January about the size and pace of rate cuts this year.
100 basis points of cuts. We had them starting in July and going every meeting after that. And then we had a pretty dovish Fed to start this year. And we pulled that forward to June with 125. And that's been the call since early January.
Veronica Clark is an economist at Citi, and she's sticking with that call for the rate cuts totaling 125 basis points this year. That's 25 basis points today, then 50 basis points at the next 2 meetings, or 50 basis points today and in November, followed by a 25 basis point cut in December. No stranger to bold calls, she was one of the very early economists correctly predicting larger hikes in 2022. Veronica joins us right now. And Veronica, when you made that call back in April, we thought it sounded a little out there, but you seem to be more right than most people in the street.
we had a
Why did they think it sounded like it was way out there? Because they weren't paying any attention to the yield curve. It's just straightforward. They weren't paying attention to any of the stuff that should be glaringly obvious that we talk about on this channel constantly.
a couple months where we sounded pretty crazy. But yeah, I think things have come around to our view, and that has been premised on the labor market weakening, which we're really seeing signs of in the data really at the end of last year, and that weakening has just accelerated. And I think the Fed has, of course, caught on to that. And
okay, so that's my quick suggestion to Veronica. When you're making a statement, Veronica, you have to make a statement. You can't make it sound like you're asking a question, because, and Josh, take notes. For anyone that you come across in your age group that tends to talk like this, and you know what's weird? This is an American thing. Like the European women, the South American women, they don't do this. But for some reason, and what's bizarre is the men in the United States have picked up on this exact same thing, where they can't just make a statement. I think the color is red, as an example. They have to say, I think the color is red. like you're that feeble. Like your confidence is that low that you can't even make a statement without making it sound like a question. Like, oh, well, I think the color's red. It's just, I can't stand it. I can't stand it. Though that's one of my pet peeves. The other one is always saying, I feel like. I feel like. Back in the day, we used to say, I think. Most of you probably remember that watching this video. Remember when you'd say, how can I get to the nearest Circle K? They would say, well, I think what you do is go down and take a right. Now there is no thinking. We've eliminated thinking, not just from, well, ironically, we've eliminated thinking from our vocabulary. At the exact same time, we've eliminated thinking altogether. So maybe there's an interplay between vocabulary and the way we actually behave as human beings in society. But it's always, well, I feel like what you do is go down. No, you think. So Josh, take a note. Anyone in your age group that you see doing this, make sure that you correct them. Ask them, do you feel or do you think? They should be saying they think 99% of the time. And then remind them when they're making a statement, don't make it sound like you're asking a question, because you sound like a feeble weakling, for heaven's sakes. Have some confidence, Veronica.
Is increasingly worried about the employment side of their mandate.
There is a pretty large crowd on Wall Street who still say 50 basis points would not make sense at this point, that that's too aggressive.
I think it would make a lot of sense. I think there's a lot of arguments for 50. We really don't know what is going to happen today. I think maybe 25 is the where we can get the most agreement among Fed officials. 25, a dovish 25. They have to be sufficiently dovish here to not scare markets that they're maybe behind the curve, tighten financial conditions more. And I do think there are 50 basis points on the table for the next coming meetings, and maybe, of course, today.
Do you think they're behind the curve?
I think there is a good argument to make that if they had had that July employment data that we got just a couple days after the July meeting, they could have cut at that July meeting. And so in that sense, you maybe are a bit behind the curve here. The weakening trend of the labor market has just continued this whole year. It might be a bit too late to prevent that at this point. And certainly,
notice it might be too late to prevent that. Remember, guys, have we been going over the chart for the SOM rule and just basically a derivative of unemployment? And we look at this relative to past recessions, and we see that once you get to a certain point, the unemployment rate rarely, if ever, goes up quickly and then just flattens out and then declines, especially when you combine this with an inversion of the curve. So what we see in cycles over and over and over and over again is the unemployment rate gradually come up, and then it goes up by that 50 basis points. The 3-month average or moving average goes up 50 basis points above and beyond its low point over the trailing 12 months. And then you see the hyper acceleration of the actual unemployment rate. And, I was listening to my good buddy, Jeff Snyder, this morning, and he made a fantastic point. Obviously, he's neck deep in this stuff 24 hours a day. And he said that usually what you see in cycles, the reason why you see that gradual uptick that we've noticed in the SOM rule, and then it goes parabolic, is because the initial weakness in the labor market doesn't come from layoffs. The initial weakness actually comes from a decrease in the trend to hiring. And then that leads to businesses cutting back in other areas. And that leads to businesses then, once you're into the cycle, coming to the conclusion that the only thing they have left to do in order to not go bust is to start laying people off and firing individuals. And then that's what really impacts that aggregate demand, which takes you from, let's just call it a soft landing, into a hard landing. So here, I want to give kudos to Veronica. She is pointing out that usually when we see this type of softening in the labor market, and I mean usually, I mean 95% of the time, especially when the curve is inverted, the Fed is behind the curve. That's why we always say the Fed's not responding, or the Fed is not preventing a recession by its rate cuts. If you look at past cycles, they've only been responding to one. And as she points out, usually once you get to that 50, 57 basis points where we're on the SOM rule, it's too late.
You want to take rates closer to neutral, and you don't want to do that a year from now. You want to do that sooner.
I mean, the labor market's still in pretty incredible shape if you look historically. It's hard to argue anything with a four handle is out of control or hugely concerning. That's full employment.
It's hard to argue anything with a four handle is concerning. This is a view of someone who's never studied history. Never studied history. Yes, it is true that anything with a four handle, that in and of itself is not concerning. But you have to look at the trend, for heaven's sakes. No one is saying that 4.2 or 4.3, where we are right now, is concerning. It's the trend, for heaven's sakes. That's like saying that the 10-year Treasury yield being at 3.6. Well, this is really concerning. Well, no. It's the 10-year Treasury yield based on what it's done over the past few years, based on where Fed funds is, and based on the entire curve, along with the other data that we have to look at, such as oil prices and such as unemployment. But thank goodness Veronica stands her grounds and corrects the gal.
By historical standards.
Right. The level of the unemployment rate is certainly not necessarily concerning. It's really the change that matters. And when you do see the unemployment rate rising this much, historically, that does, precede a recession. I think Fed officials are, maybe complacent is not the right word, but are, feel okay about the labor market because you don't really see the big signs of layoffs yet, which is true. Although in the last couple months, we have started to see those building. But if you're waiting to see widespread substantial layoffs, you're already too late at that point.
The only problem is you're still watching inflation, and they are not back to their 2% target. So
okay, so we did a video on this the other day. And this gal is saying, oh, okay, we're at 2.5%. They're not back to their target rate of 2%. But like we discussed, if you actually look at real-time data and things like the cost of insurance, if you look at real-time data as far as the cost of rents, I'm not talking about the housing, but rents, which is what they're claiming they're using in the form of owner equivalent rent. But if you use the real, because this stuff lags 6 months to a year, maybe longer. But if you look at the real-time data, just for those two metrics alone, that takes the CPI. And again, I know it understates it. I always want to preface with that disclaimer. But we're looking at the trend, and we're looking at what the market or the Fed is basing their decision off of. So if you actually look at real-time data, the punchline is that we're not at 2.5%. We're under 2. We're under 2. So the inflation argument based on the CPI, it's not really that strong in my view. Now, if you look at I think it's called core or PPI, when you strip out, I think, food and energy, that's something that the Fed looks at more carefully. And this, you've seen a slight uptick, or maybe it was producer prices. I can't remember right at the top of my head. But that, I think, is a better argument than just looking at the CPI. Although, now that I'm saying this out loud, if you're looking at the CPI minus or an inflation gauge minus food and energy, that still would include housing prices. So I guess there would be an argument for that being a lot lower than the headline number as well. Getting back to the interview.
This is not a single mandate by any stretch. They may be focusing a little more on the labor market these days, but the real mandate that if you look back at Fed officials from years back, Alan Greenspan in particular would say, I don't worry about the labor market. I worry about inflation, and the rest takes care of itself.
Right. And we certainly are coming from a higher inflation place than we've been in many years, many decades. And I think that's maybe why, after we saw the CPI print last week, that's really what led us to change our call from a 50 today to 25 today. The Hawks might not be quite on board with 50 yet. Maybe 25 is where you can get the most compromise. But I think there are a lot of signs that inflation is finally slowing. The strength that we had in CPI last week was in the very lagged shelter component. And we do see housing weakness.
I didn't even know she I completely missed that. When I watched this interview before, I totally missed the fact that she pointed out exactly what we were just saying about there being a huge lag with owner equivalent rent. And by the way, that's 33% of the calculation for that headline CPI.
Rents coming down, I think that will be slowing, and just generally a weakening labor market with wages also slowing. That is a good sign for target inflation.
We spoke with the CEO of KBW earlier this week, and his point was you don't really want to make 50 basis point moves. Moving 25 basis points, kind of marching along at that level, there's a reason for it. Beyond just worrying about what investors think, it's because banks need that time to make sure that things don't go.
Again, completely oblivious to history. Just saying, you don't really want to do this because look at the signal or the message you're sending to the market. And you just kind of want to take these stagger steps down. So over the course of the next year and a half, you get down to the neutral rate or R star or the terminal rate or whatever the hell they call it. But this completely ignores the fact that there's even a 1% probability that we're going into a recession. It completely ignores that, which is another way of saying she's ignoring history. Because almost every single time we go through one of these cycles, especially when you combine this with the SOM rule and all the other market signals we've been receiving over the last couple months, when the Fed drops rates, they don't just drop rates slowly. They drop rates very, very quickly. Not at the first one. As this gal points out, they did a 50 prior to .com. They did a 50, I believe it was 2007, and she'll discuss that in a moment. So it's not like they just go like in the survey sickness where they drop by like 100 basis points. But when they go down a lot further and a lot faster than this just little stair-stepping thing because they're not responding to inflation hitting their target. They're not responding to them sticking the landing. They're responding to the stuff hitting the fan.
Haywire in the loans that they're writing too.
Yeah.
If you have lockstep 25 basis points, if you think things are maybe 100 to 125 basis points too tight, you don't cut that overnight. You go gradually.
Right. But it's not
especially when it's not an emergency.
Yeah, but it's not really unprecedented even for the Fed to start with 50. They did that in 2007, and we didn't even really get the big pullback in GDP growth until 2008. They started with an emergency 50 in January of 2001. The unemployment rate was actually even lower than it is now.
But I will say in both of those situations you were talking about.
You hear what she said there? And this gal's trying to talk over her because she's like, don't sound bearish. We can't say the R word. We can't say the R word. But what that gal said was very important. She said going back to 2001, when they dropped by that 50, she said unemployment was lower than it is today. So this completely debunks the whole, we've got nothing to worry about, because historically speaking, inflation the unemployment rate is relatively low.
Much bigger problems on the horizon, 2001 and 2007. 2007, anybody in the industry knew that there was some serious stuff on the line.
Now, this is laughable. Did you hear what she just said? She goes, this is nothing like 2001 or especially 2007, because she goes, in 2007, she said, everybody knew that there was something serious on the line or seriously wrong, or however she phrased it. I mean, give me a break. Come on. How much BS can we possibly shovel right here? It's just, it's like a revisionist history. Like, go back and read the Wall Street Journal from 2007 and show me a consensus. But watch CNBC videos from 2007. Show me the consensus. And by the way, you've probably seen a lot of them on my good buddy Schiff's channel, where they're literally laughing at Peter. Oh, you idiot. You think we're going to have a recession? You think there's going to be a housing crisis? Oh, what a moron. The same people that she is saying universally knew that there was a big problem in 2007. I mean, this is total nonsense. I can't remember whether Veronica calls her out on it. Let's see.
Yeah.
things roiling in the.
You can tell she's like, and I will give her credit because I don't know how many times Veronica's been in this position. Obviously, a young gal. I think she's holding her own very, very well. But I like how she is pushing back a little bit. And when she's saying this, you can tell that she's like, this gal is completely full of it. You can tell just by kind of how she's responding. She's like, yeah, not really.
The back markets that could take lots of other things down.
Yeah.
2001, again, you're talking about very different situations than what we're dealing with today.
Right. I would just look at the labor market data, and I don't think anyone should conclude that we're not headed towards a weaker labor market based on what we've seen in hiring trends and the increase in the unemployment rate. Again, if you're waiting to see layoffs, you're already too late at that point.
Boom, 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 boom. So she is trying to be nice and respectful, but she's going right back to saying, look, if what we have seen, based on what we've seen in the labor market, we should expect further weakness and a lot more weakness. And if we see more weakness, what she didn't say is that means hard landing. That doesn't mean just a flattening or a reacceleration in growth or whatever it is. It means this cycle isn't different, for heaven's sakes. At least it hasn't been different up until now. Again, at the end of the day, there are only probabilities. There are no certainties. Okay, Josh, let's go ahead and switch up the screen share. And we're going to go to, okay, there we go. Let's go over to the CNBC homepage. I want to check out what markets are doing just before the announcements, so then we can cross-reference the price action with what happens after the Fed decision. Actually, before we do that, let's go to the CME and see what the odds are right now. Why is this not popping up? It's wanting me to accept all these stupid cookies. Ugh. Jeez. Yes, you can track me across the internet. I hate that. Can you at least load now that I've accepted your Orwellian policies? It won't even work. Josh, can you pull this up on your end? I'm going to go to the CNBC homepage. Just pull that up on your end, please. It was almost 50-50 the last time I checked. Can you pull that up? Or at least just let me know what the odds are. You don't even have to pull it up and do a screen share.
Okay, I'm looking it up.
Okay, so while he's doing that, and Josh, hurry, you've got basically a minute. But getting over to this, I want to check markets prior. So right now we are, okay, pretty much flat across the board as far as S&P 500, NASDAQ. Let's look at 10-year. I'm going to write this down, actually. 3.692. And so pretty much flat on the 10-year. Oil, pretty much flat. Yeah, I think everyone's just kind of holding their breath waiting for this Fed decision. Gold, pretty much flat. Bitcoin, same thing. Okay, were you able to find the odds there, Josh?
It's not pulling up because I think it's
I
trying to update real time.
I got it. It's 57. Well, assuming this is real time, it's 57% for a 50 and 43% for a 25, which would I'm actually hoping we get a 25 just because I'd like to see how markets respond. And also, that reminds me, I'd like to get a 25 just for my own personal portfolio, because if we get a 25 basis point cut, I think that's going to present an opportunity, an investment, or maybe a speculative opportunity that I'll talk about at the end of this live stream. So you definitely want to stay tuned for that. Let me just write this down so I don't forget. Okay. So, okay, here we go. 1 o'clock, 1 my time. 2 p.m. Eastern. So let's go back to the home page, see what's going on. And then we'll see if we can go to like a YouTube live stream where we're getting, I don't know if Powell does like a press conference right afterward. They should have like a breaking thing at the top of the screen. Let me refresh. You guys let me know in the chat. Actually, we could go to the chat real quick and see what people think. Oh, everyone's saying 25, 50. We got a couple 50s. Oh, confirmed 50? Was that confirmed? Or is that fake news? Fed slashes interest rate by 0.5 point. Wow, you know, it's amazing how often I get this stuff wrong. And what I'm talking about are these short-term like predictions, like what's going to happen tomorrow. I'm really good at getting like the midterm right. Like if you go back to my videos, you'll see that I was calling for consumer price inflation back in 2020, 2021, and then we got up to about 9, and then I started calling for disinflation, which turned out to be correct. And then I was talking about, as you got most of you know, buying calls on the NASDAQ because we were talking about narrative. I got that just spot on. And then I started buying TLT, what was it, back in July or so, because I saw the trend going down with rate, got that right. So these swing trades, if you were, these midterm trades or predictions, I'm really good at. But as far as a short term, you can just bank on it. Whatever I say is going to happen tomorrow, just do the opposite of that. Because yesterday I said I was about 50-50, but I said if I had to guess, I'd say 25. And sure enough, 50. I was wrong. So, wow. Okay. 50 basis points. I guess the CME got it right. Let's see what's happening here. Okay, so as you would expect, the S&P 500 rips, NASDAQ rips. My guess is bond yields went down, which is great for me because I own call options on the TLT. I still have half the position. Those of you that are in Rebel Capitalist Pro, you know exactly what I'm talking about because we do live stream, member-only live streams on my model portfolios all the time. But let's look at the 10-year. Oh, the 10-year. Okay. That looks like it actually crept up a little bit. Interesting. Okay, so Bitcoin way up, well, 1%. Gold in the green. Oil about the same. 10-year, if this is real time, it might not be real time. But as of right now, 10-year up by, call it 3 basis points, something like that. So what's going to be really important is to hear what Jerome Powell says to the market. So I heard a lot of people on CNBC earlier talking about a 25 basis point cut with dovish Fed speak. Are we going to get a 50-point basis cut with hawkish Fed speak? I guess that's the next question. So let's go over to their Fed set to cut rates, but market reaction may depend on size of move. Okay, let's go over here and see if they've got a live stream to Powell. Josh, do you know what time Powell comes out and speak? I'm guessing probably at 2:30.
I'm looking right now.
Okay. And by the way, while you're doing that, I'm curious. Let's go back to Fed funds and go back throughout history as far as when they cut and see if there's times when they've cut by 50 where we have not gone into a recession. So let me look at a Fred chart. So the Veronica was saying that .com and GFC, we had 50, so we don't have to look at that. And I know Cerveza sickness, we had like 100, or maybe even 150 point drop right here when they came out with that emergency meeting. But I guess their first drop looks like 25 basis points, if I can zoom in. Yeah, it looks like probably 25 was that first drop. But then this is that emergency meeting that I was talking about. Oh man, I thought they dropped it by 100 basis points. I thought they went from 1% down to 0. It looks like they went, or maybe they went from 65. Bottom line is they dropped by 150 basis points pronto. Like fast. All right, let's take this same thing and look at GFC. So this is what Veronica is talking about when they dropped the first. Well, it looks like the first drop here. Huh. I'm not sure what she's referring to because it looks like the first drop here was 25 basis points as well. And this shouldn't be a range like it is today because they didn't have IOR. So maybe Veronica was just referring to .com. Yeah, this looks like it was most likely a 50 basis point cut right before .com. And GFC, unless I'm not reading this chart correctly, which is extremely possible, I'm not seeing a 50 until we got to where the stuff, well, again, according to, if you would have gone back and looked at CNBC and listened to them back in January of 2008, when the stuff started hitting the fan as far as the recession, and this is according to NBER, which they finally announced in December of 2008, you would have heard the same thing. People like Veronica would have been coming out saying, hey, look, the unemployment rate's going up. We've got the, I don't know if the SOM rule was a thing back then. We've got the inversion of the curve. We have this bull steepener. It looks like the unemployment rate is going up. You know, it's going to continue to go up and accelerate. And we saw this happen during the dot-com bust, right? Because again, they're pre-GFC. And you can imagine the talking heads at that time saying the exact same thing and just throwing their hands up in the air and saying, oh, are you crazy? This is obviously not the dot-com bust. I mean, look at valuations of stocks. Look at the NASDAQ. Look at this. There's no way we're going to have a hard landing. I mean, this is nothing like the dot-com bust. And they'd say, well, if we go back to the recession we had in the early 1990s, oh, this is nothing like that. I mean, that's when we were invading Iraq and we had oil and Saddam Hussein and blah, 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 blah. So right now in 2008, and we're not invading anybody. We don't have a dot-com bubble. So no, this is obviously, this is not, or this has nothing to do. This bears no relationship whatsoever to the last two recessions. That's exactly what they would have been saying in January of 2008. It's always works out. And during the dot-com bubble, they would have been saying the same thing. Oh, you can't compare this to the early 90s, blah, 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 blah. And in the early 90s, they'd have said, oh, you can't compare this to the 1970s. Those recessions were way different. We're in an inflationary period right now. Now we're in disinflation. This disinflation is going to prevent any recession. And now, by the way, we've got Alan Greenspan, the maestro, who is much more respondent to the marketplace, where back in the 1970s, you had Arthur Burns and Paul Volcker. They didn't pay any attention to the market whatsoever. So there's no way we're going to have a recession in like 1990, 91. Absolutely not. This time is way different than the 1970s when we had our last recessions. It's like, this is how they talk every single time. And what's amazing is it never changes. It never, ever, 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 ever changes, regardless of history. Like, they don't even acknowledge it. Now, I want to be clear. I am not saying there's a 100% probability that there's a recession or a hard landing, or that this time the cycle plays out pretty much the exact same way that it's played out 90% of the time going back to the 1950s. But I'm saying that when you look at the data, such as the curve, such as the SOM rule, and I know people will push back against the curve. We've already debunked that. People push back against the unemployment rate because the supply side. We've already debunked that. And then people push back in corporate earnings. Okay, great. That's a rear view mirror type thing. And it is true. I'm not saying all the data is bad and softening. No. But we're seeing more and more and more and more. When you combine that with what's happening in unemployment, you combine that with what's happening with the curve and the oil price, et cetera, et cetera, et cetera. It's just a matter of the probability shifting more to one side. That's all my position is. That's why I sit here and pound the table. I don't sit here and pound the table saying, I predict a recession, I predict a hard landing, and we're going to have it. There's a 100% probability that we will. And anyone that thinks we don't, that we won't, is absolutely stupid, and they're not doing the research and blah, 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 blah. Now, I'm just saying they're not paying attention for whatever, and I can't figure it out, but they're not paying attention to the entirety, the totality of the evidence, which includes what has happened in history. And I'm someone that puts a much higher emphasis on history than what we're seeing currently and what the talking heads are saying we will see in the future. Because when you go back and look at these cycles, the talking heads are always wrong. Ask Peter Schiff. Ask Peter Schiff. Not saying that Peter was wrong. I'm saying he was right. And all the talking heads were literally laughing at him. And then they'll say the same thing. Oh, George, well, you're comparing that to the GFC. This is nothing like the GFC. We're not even close to being in danger like that. How do you know? How do you know? How do you know we're not on the brink of something? Did you call the yen carry trade? Did you call that? Did you call Silicon Valley Bank? First Republic? Signature? Credit Suisse? Did you call any of these things? No. If I would have asked you a week prior to Silicon Valley Bank blowing up, you, the talking head, would have said that we are in no danger of a banking crisis whatsoever. If I would have asked you one day before the yen carry trade blow up, you would have said, oh, no, there's no evidence whatsoever that we're going to have a blow up. No evidence of that. There's no evidence that you have. See, and again, this goes back to the asymmetry of information that I always refer to. You've got to ask yourself which camp you're in, because you can only be in one of two camps. Number one, you think that there is no information asymmetry, which is what the talking heads think and a lot of the quote unquote experts. Or, like me, you think there's massive information asymmetry. In other words, I have this much information. The Treasury market has this much, has 1,000 times the information and insider intel that I will ever have. And therefore, I can't sit there and assume that I have the exact same information. Therefore, the Treasury market is just wrong. I've got to assume that they have insider intel that I don't have. Not saying that they're right every time, but I at least have to acknowledge that and use that as an input to my analysis. And if I completely ignore that and say, well, they're wrong because of the information that I have at my disposal, that is, in my view, the type of arrogance that gets you in a lot of trouble if you're managing money. All right, let's get back to, oh, actually, I forgot what I even wanted to do there. So let's go back to the 1990s and see what type of cut. So here that first cut looks like, yeah, I'm not really sure. But it looks, based on this, and Veronica probably knows a lot more about this than I do. I'm sure she has access to better charts than the Fred charts. And she's saying 50 and 50, if I understood her correctly. What I'm seeing is 50 and 25. But let's get back to homepage, see how markets are responding. Here's what's changed in the new Fed statement. Okay, let's look at this. This is the comparison of Wednesday's FOMC statement with the one issued in the prior meeting. Ah, okay. black text appears in both statements. So they change. Oh, this is interesting. So they changed job gains have moderated to job gains have slowed. Okay. I guess that's implying a little more softness in the labor market. And the unemployment rate has moved up, but remains low. Inflation has eased over the past year, but so this is what they omitted. Eased over the past year, but remains somewhat elevated. Recent months, there has been some. So, okay, inflation has made further progress toward the committee's 2% objective. I wonder why they took out inflation before objective, but remains somewhat elevated. Huh. And they say the committee has gained greater confidence that it's moving towards 2%. So far, this is pretty dovish, guys. In light of progress on inflation and the balance of risks, again, more dovish. The Fed, okay, we're talking about the rate cut. Committee will carefully assess incoming data. Okay, yeah. Oh, look at what see, this is a good example of often it's not just about what they're saying, but what they didn't say or what they said last month and have deleted. Here's what they deleted, or another thing they deleted. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moved sustainably towards 2%. Okay. Well, I guess they would take that out because they dropped rates. But I think that also is sending a message that the overarching theme is obviously we're not really worried about inflation. We're a lot more worried about the labor market. And if they're a lot more worried about the labor market, that tells you they are a lot more worried about a recession, even if they don't come out and say it. Behind the scenes, that's what's going on. That's the way I interpret this. Let's see. So, Josh, did you see if Powell is making a statement? Is he making a statement at 2:30? Gives me a time to finish my lunch. Josh, are you there? You check out. I can look it up. See, this is why I have a research assistant. So they can completely ignore me when I ask them questions. Oh, okay. All right. Good. In fact, I should just use the chat as my research assistant. They're doing a much better job than Josh. So 5%er says yes, it's at 2:30. Gabriel says yeah, 2:30. Jordan, yes, 2:30. Sam, 2:30. I want to give everyone credit here. Okay, fantastic. Exactly. TJ Vaughn says, Josh, WTF. That's great. Okay, let's go back to the CNBC homepage and see if the markets are doing anything weird. Although it was weird that the 10-year went up. Definitely surprising. But that's fantastic. Absolutely. Actually, that gives me an opportunity to discuss the what I'll probably do to my portfolio, one of the model portfolios I have in RoboCapital's Pro. I was actually hoping they would get a 25 basis point hike because I thought if they got a 25 basis point hike, the TLT would go down a bit, which would give me a better entry point to put on more call options. Now, to be clear, and you guys know this if you saw my conversation with Patrick Ceresna the other day, What I'll most likely be doing is putting on that position by buying options on SOFR futures, because there's almost zero liquidity with the TLT call options that I purchased, which fortunately I was able to liquidate half the position at a 50 or 60% gain, which is great. But I kept the other half of the position. I'm keeping it because I like the entry point. I like the asymmetry, but I hate the liquidity. So I'm trying to do the same thing with SOFR futures. And I thought if we had a 25 basis point cut instead of 50, that would give me a better entry point, because interest rates would go up, in my view, temporarily. But it looks like we could be getting that opportunity even with this 50 basis point cut, which for me in my portfolio, fantastic. And now we're seeing the 10-year go back down a little bit. Let's check out TLT now that we're on the topic. Just see what is going on there. Huh, that's weird. I wonder why it. Well, I guess you would expect some volatility around the Fed, around the decision. So it was down today, well, not substantially, but it was down quite a bit today, and then has been going back up. I like the fact that we are closing right around the high points of this resistance level, going back to looks like it's going back to 2023 December. So right here we're at a high, and I'm by no means a chart guy or a technical analyst. This is just the stuff that the easy peasy stuff, the basic like 101 stuff that I know. My buddy Steve in St. Bart's, the former hedge fund manager for 40 years, and one of the most successful hedge fund managers I've ever met, maybe possibly one of the most successful managers of the last few decades. But this is what he uses quite a bit. He just uses these simple resistance and support. So, right around here, we're looking 100, maybe 100.5 here, right around 100. And here we kind of broke that. So I think what I would be looking for is a close above probably 101. And if we see a close above 101, that's probably what I'll use to time the entry point for the options on the SOFR futures. But it's I guess the 10-year. So what that would tell me is the long end of the curve. Now, what just happened here? So what? Maybe they just the market just responded to the Fed comments that we just read, because this is just a one-day chart. So this would be Eastern time. So we had, now this was a massive drop right at 2 p.m. So what happened is the 2-year really responded to the 50 basis point cut, and it's continuing to respond by just tanking here. But the 10-year really didn't budge, assuming that we're getting real-time data. So let's look at Market Watch, which I think is a little bit better than CNBC for that. And let's look at a 10-year. Because what this is telling us, guys, is that the spread between the 2-year and the 10-year, in other words, the uninversion, is becoming more extreme, which increases the probabilities that the uninversion is sustained and it's not just a head fake. Why is that important? Because that's part of the cycle that we go over. We go over inversion, bull steepener, unemployment rate goes up, then you get a sustained uninversion, and then you usually get the Fed rate cut. And then you get the stuff typically hitting the fan. Who knows how it plays out as far as time frame within each of those, but that's kind of what I use to check off the boxes. So it's like, okay, we got the inversion, check. We got the bull steepener, check. Okay, we got the unemployment rate spiking, check. Okay, now we've got the sustained uninversion that we've had, not just today. I want to be clear. This uninverted, what, maybe 2 weeks ago? It uninverted way back during the yen carry trade, but that was quick. And then it inverted again. We got kind of a head fake. But what we've had is a sustained uninversion for the last, let's say, week. And now it's getting, that spread is getting even more extreme, which would imply to me that that box, go ahead and check that one off as well. And oh, by the way, the Fed dropping rates, you can check that box as well. So that means out of the entire cycle, there is only one more box to check. And anyone that wants to argue that this time it's different, just show them that checklist I went over and just say, how is it different? like, okay, I get it. We might not have a recession. I grant you that. That's your view. Totally cool. Totally cool. I respect that. But you can't say that as far as the cycle, this time it's been different. Well, what are you talking about? It's literally been the exact same. Let's go through the checklist. Bam, 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 bam. All right. But the main takeaway here with what's happening with the 10-year, but this is interesting. Oh, I see. Okay, so I also didn't realize that at the 10-year was up as far as the yield quite substantially for the day prior to the cut decision. So now that let me just refresh to make sure we've got, okay, so now we're at 3.66, which is right around where we started the day, but we have seen a dramatic decrease. So, okay, this is less surprising than I initially thought, because I was assuming that we were up based on where we were prior to the Fed decision, because I thought that pretty much the market was flat for the day. I didn't realize that the market went up as far as yields prior to this decision. Okay, so this is making much more sense. But my bigger point is the delta. So we're at 3.66 on the 10-year. Yeah, see, it's almost 10 basis points. Almost 10 basis points. And the 2-year went up as well during the day and then has gone down. Let's just say, I mean, we were right around 3. Oh my God. Yeah, it's down almost 10 basis points. And we'll have to see how it closes out the day. I wouldn't be surprised if it closes out the day lower and we see that spread increase. But you guys know how I am with these short-term predictions. He'll probably do the exact opposite. Now let's look at the 30-year. All right. So down a little bit since the decision, but not much. So this kind of tells me that the market it's kind of assuming the Fed is going to drop more than they say, but it's not assuming yet that we're going to have this really hard landing. Because if it was assuming that, then you'd see the 30-year drop quite a bit as well. In other words, just kind of using it as a proxy for the long end of the curve. This is just my interpretation. Take it for what it's worth. So, but I think this is the opportunity. Because if you look at, just as an example, where options are trading, there's like a not even a 1% probability the option market is giving the the long end of the curve going back to where it was in 2019. I mean, I'm not saying that's my base case, but it's a hell of a lot more than 1%. And the thing is, if you're right on that, the returns are staggering. I'm talking about 10x plus returns. So that's another example of kind of the asymmetry that I try to look for in trades, and I guess and in investments as well. And it's not like I just created this. I want to be crystal clear. This is just what I've learned from reading a lot of books, like the Market Wizards books. Should be somewhere around here. There it is. And then talking and learning from a lot of guys and gals that I have the opportunity and the good fortune of knowing. And
hey, George, the Jerome Powell just started.
Okay, so where do I find that, Josh? Josh finally
If you just
decided
go
to do his job.
If you just go to YouTube,
I had the
and,
chat do your job for you. They were crushing it, man. They were crushing it. All right, what was it? Go to YouTube and do what?
Even right now, CNBC's live, or I mean, there's countless. If you just look up Fed live.
Here, let me just watch live. Okay, here we go. Oh, now, do I have to switch up the screen share for this? I don't think I do. Do I?
You will, if you want people to hear it.
Ah, right. Okay, so let's. And we're going to do Chrome tab. And so we want to go to CNBC. Okay. So this is correct, right, Josh? You can see it?
Yep.
Okay, just let me know about the audio.
In a context of moderate growth
You hear that?
and inflation moving sustainably down to 2%.
Yeah, we can hear everything.
We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after I
More
briefly review
QT.
economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up.
It hasn't remained resilient, only in nominal terms. We discussed that yesterday. If you look at real terms, it's down
From its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years.
Well, that's interesting. I just want to point out that GDP growth in Q2 of 2008 was 2%, 1.9 to be specific.
In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated.
If it's less tight than what we had in 2019, dude, why do you have interest rates even at 4.75? I mean, go back to this Fed funds chart, for heaven's sakes. Look at where the Fed funds was in 2009 when Powell's talking about this, or 2019, I'm sorry. 2009, Fed funds at maxed at 2.4. 2.4. So what are we doing? I mean, again, I'm not implying that the Fed is really important, all these things, but just using their logic, for heaven's sakes, what are you doing at 4.75? Anyway, let's get back to it here. Where did it go? There it is.
Inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%.
Of course it is, because that's your target. I love how it just so happens that their longer term projection just happens to match up perfectly with what their target is. Oh boy, you can't make this stuff up.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has.
So we know how important inflation is, but yet we don't think it's important to include it into the retail sales numbers. Okay.
Help restore the balance between aggregate supply and demand, easing inflationary pressures, and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote that
it's amazing how important they think they are. And I get it. It's Jerome Powell's job. And I think at the end of the day, he realizes the Fed is effectively impotent for the most part, unless you're talking about bailouts or something like that. But look, what is the difference between 25 and 50? Are you really going to tell me that if you would have dropped down, let's say to 75 basis points, then uninflation would have just ripped higher and we would have had this explosion in consumer prices, and 6 months from now we'd be right back to 9% on the CPI? Come on. And then if we would have done 25 instead of 50, then all of a sudden the economy would have imploded and we would have gone into the GFC, or we would have definitely had the hard landing. I mean, they give them that much credit to the point where they try to get you to believe they can just micromanage the economy just by turning this little dial like it's a thermostat in your house. Like, I don't know, 72 degrees, it's a little warm, but boy, 70 degrees, that's a little too cool. So we're going to just boom right to 71, and that's off. That's perfect. There's no way we're going to have a recession, and there's no way we're going to have an increase or reacceleration in consumer prices. I mean, come on. And if you don't believe it, again, look at history. When have they stuck the landing? Just show me when they've done that. When you've had an inverted curve and when you've had the unemployment rate spike to the level of triggering SOM. Just show me the time. It doesn't exist. It doesn't exist. So you've got to tell me not only why this time is different, but why this cycle is different. Because to sit there and say that this time it's different, that doesn't give me any useful information. Because every time is different. Yes, the GFC was different. There were certain variables that were different than the dot-com bust. And the dot-com bust, there were different variables relative to the early 90s. Early 90s relative to the 70s. Yeah, they're all different. But the cycle plays out the exact same way every single time. Not saying that it will this time, but so far it has. And the Fed has never stopped it. I mean, honestly, they think the only reason inflation came down was just due to the Fed, as though it had nothing to do whatsoever with a supply shock. Like, oh, that couldn't have had contributed anything. The fact that we locked everyone in a cage for 2 years and stopped them from producing stuff, well, that obviously had no bearing whatsoever on consumer prices going up. Therefore, when consumer prices go down, it has nothing to do with those supply chains going back to a place where they're getting closer to where they were prior to, let's say, 2020. That couldn't be it. It has to be because of what we are doing. That's the arrogance that I can't stand. But to give him credit where credit is due, I get it. He has to say that because he's like the Indian witch doctor that has to get you to believe that he's the one that makes it rain. He's the Wizard of Oz. His only power is convincing you that he has power.
Down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025.
I want you to write that down. I'm going to write it down. Josh, well, I should actually ask the chat. I'm going to ask the chat because they seem to be much better at this than Josh today. So chat, for all of you on the live stream right now, we got 3,000 plus people. Write this down. He is saying that the Federal Reserve, their committee predicts that at the end of 2024, the Fed funds rate will be 4.4%. 4.4. Easy to remember. 4, 2 4s. So you guys just on the chat right now, or if you're watching this video after the fact, just go ahead and write that down. And then just remind me when we do a live stream on, let's say, December 31st, what the Fed funds rate is. And let's just see how close to 4.4 they are. I'll take the under. That's the best way to. I'll take the under on that all day long. All day long. Give me the under on 4.4.
These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Oh, cool. He's taking questions.
Steve Leisman, CNBC.
Oh,
Thank you, Mr.
Steve
Chairman, for taking our
Leisman.
questions.
Ugh.
In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
All right. Good question, Steve. I can't give him too much
So,
crap.
okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all.
The Beige Book. The Beige Book. You guys know from watching my videos what the Beige Book is. How many YouTubers talk about the Beige Book? I would say very few, but it's obviously very important. It's part of what Jerome Powell's saying went into their decision-making process to go from 25 to 50. And that's one of the main reasons why I talk about it on this channel. Very important. If you don't know what the Beige Book is, if you're new to the channel, it's the survey the regional banks do that's actually like boots on the ground intel. So right here, he's saying, bottom line, we just saw the labor market taking a dump, and we saw the Beige Book saying that economic activity was slowing substantially.
All of those, and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
Sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call?
It's the same thing, Steve. I can answer that question for you. It's going to be based on exactly what he said. Unemployment rate, data, which includes Beige Book.
Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time.
Josh, what's the SEP? Is that, or maybe chat, what's the SEP? Is that the dot plot? I'm not sure what the SEP is. Can you do me a favor and just look that up real quick? I'm curious. He seems to be placing a lot of emphasis on that.
Okay. It's also slightly hard to hear, Powell.
Yeah, I know. I've got the volume turned up as much as I can on both. It's just his mic or something like that. That's why when Steve Leisman first came on, his voice was a lot louder. It's just something with his mic. Oh, simplified employee pension plan? Oh, no. It looks like summary of economic projections. I'm assuming that's a report that he gets from a few of the 900 PhDs at the Fed. That's my guess, but thank you very much for that.
There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where what the committee is thinking today, but the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Josh, do me a favor really quick and tell me if the volume increases. I'm going to turn up the mixer real quick on my mic and see if that is actually applicable to the mic on the computer as well. So let me just increase the mixer. Tell me if this increases the volume on your end of Jerome Powell.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the...
So Josh, is that volume better? Because I turned it up on the mixer.
Not really.
Not really? Okay, but my volume's a lot louder, though, I'm guessing, right?
Yeah.
Okay.
Yeah.
All right, I'll leave it like this and try to speak a little softer so I'm not blasting people's eardrums out.
Committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that. And that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy.
And another thing he's not saying is what's really guiding him is the 2-year Treasury. 2-year Treasury. You guys know from watching my videos in Gunlock, says this all the time. He's spot on. The Fed just follows the 2-year Treasury. And they can sit there and talk about R star, the neutral rate, the terminal rate, and the dot plot, and blah, 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 blah. But the bottom line is right now we're at historic levels or spreads where we were prior to the rate cut between the Fed funds rate and the 2-year Treasury. And usually that 2-year Treasury is the quote unquote neutral rate, or the rate that the Fed's going to over the short term. But usually the 2-year Treasury doesn't stop going down when the Fed starts cutting rates. It continues to go down, which would imply to me that if this time the cycle plays out the same way, that the Fed is going to be going a lot lower than the 3.5 or 3.6 we're seeing on the 2-year right now.
Stance the appropriate one. We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. The balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP, all 19.
Broad support. I'm surprised, honestly, guys, that yields, I'm just looking at the little green thing here on the market watch. I'm surprised that yields aren't dropping on this. Oh, it looks like the 2-year is down for the day. We'll have to revisit this as soon as he gets done, because every single thing that I'm hearing from Powell right now is covertly dovish, in my opinion.
Of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this?
See, their mics are just terrible. You'd think they could afford some decent mics.
Yeah, we're gonna take it meeting by meeting.
And the problem with
As I
Powell is
mentioned,
he's got to get
there's
closer
no
to the
sense
mic like
that
I am
the
right now.
committee feels
He's
it's
too
in a
far.
rush to do this. We made
That's
a
the
good,
volume
strong
issue.
start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It could continue.
Very good question. I can tell already.
Continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Oh, and by the way, just looking at the labor market through the lens of the Somm rule, because Jerome Powell is saying how strong everything is, and we want to keep it there. Okay, well, just go back in history. And what do you think the Somm rule was, or the spread between the 3-month moving average and the low point of the trailing 12 months back in April of 2008, when GDP was, call it 2%? That would be 50 basis points. I know this right off the top of my head. And right now we're at 57 basis points. So there is literally no difference. In fact, the labor market is worse. And you could argue the economy is just as bad or in the same place as it was in April of 2008. And nobody would argue the economy was quote unquote strong back then, or the labor market was strong, or we weren't even in a recession. Even the NBER came out and admitted it several months later. So to say that the current data implies that there's a very low probability of recession, that is complete nonsense. Now, if you took it, if you look, and now I will agree with Powell that if the Somm rule was not triggered and you had unemployment at 4.2, yeah. And if the yield curve was nice and steep, then absolutely, absolutely. But again, we've got to look at the data in totality. We can't just sit there and say, well, the unemployment rate, these blinders on. The unemployment rate is 4.2, therefore we have no problem. GDP is at 2%, therefore we have no problem. I mean, but I guess that's the only way that you could argue that the economy is doing well, is if you cherry pick and you just look at data points in complete isolation.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry,
again, dovish, guys. That's in my view is about as dovish as it gets from Jerome Powell.
Your other question was,
well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
so I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%.
Those could be famous last words right there.
So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking of.
Yeah, this is based on the video that I was just talking about, how we were saying that those bank reserves are going from the RRP back up into the banking system, which this is why I was kind of calling out, for lack of a better term, this Barron's article that says that excessive cash would lead to a lack of liquidity in the banking system. Powell is saying the exact same thing that I was saying there. And now he did say that the bank reserves aren't down that much. Well, they're down by $1 trillion over the last, call it year and a half, or my memory serves me right, since the end of 2022. So maybe a little over a year and a half. But the main takeaway there is that he's talking about the Fed's balance sheet and how those reserves go down into the RRP, leave the banking system, but still stay on the Fed's balance sheet. And then when they go back into the banking system, still on the Fed's balance sheet, didn't decrease the size that in and of itself, but it added to the amount of reserves in the banking system, while at the same time, the Fed is reducing the size of their balance sheet by allowing some of those assets to mature.
About stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Yep.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment. Is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that
Can we please stop using the supply side argument for the unemployment rate going up? How many times does this have to be debunked? I mean, just do some homework, for heaven's sakes. Oh, this gal from the FT? I mean, come on. Like, look, I am a schmuck on YouTube. Almost flunked out of high school. Never taken an econ class. I have no credibility whatsoever. None. Zero. I've never been trained on how to do research. I don't understand the scientific process. I can barely do math. I'm basically illiterate. But yet somehow I can figure out that this isn't a supply side issue because the way they calculate unemployment is using census data from 2022, according to Goldman Sachs. If I can figure that out, how can the Financial Times not figure that out? It's just, it's intellectual laziness, in my view.
something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching.
That's what Snyder was talking about this morning, just FYI.
Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market. But this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a.
I just can't take anyone seriously that uses the retail sales data as evidence that the economy is doing well. I'm sorry, but I just cannot take that person seriously. When you're talking about nominal, do we really care about the prices when you're trying to determine economic growth, or do we care about the number of units purchased? I mean, come on. Again, based on this logic, Venezuela is the best economy in human history. Based on this logic, the three best economies over the last, let's just say 40 years, are Venezuela, Turkey, and Argentina, based on nominal retail sales numbers. They don't, obviously this is half joking here, but in a way it's to prove the point that most of you already know, that nominal retail sales don't mean anything. I mean, come on, who are we trying to kid here? The only thing that matters is real inflation adjusted, because what we're trying to figure out is how many units were sold, not the price of the units that were sold.
Solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
I'd just like to point out, we did a video on this the other day, and I can't remember the report. Josh, maybe you remember, but it was something with a C, not the Commodore or something like that. It was the report that comes out from the private sector based on layoffs, and they survey CEOs and employment managers of different companies, and what they saw is that future layoffs based on their surveys are at the same levels as they saw during, I think it was the GFC, if my memory serves me well. I wish I could remember the name of the report. It's something with a C, but I just wanted to point that out as a counterpoint to what Powell is talking about in regards to layoffs.
Michael McKee with Bloomberg TV and radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think.
Okay, now he's pretty much saying the same thing over and over and over again here. So we're going to have to see how the market responds to this. So let's go back to the CNBC homepage. Josh, hopefully you can see this. Can you now see the homepage here?
Yeah, you can see everything.
Okay, great. So let's do a quick review or a quick update. And we see, the market has come down. It's not as high. In fact, it's come down a lot since they made the announcement for 50. And we've got bonds. 10 years still up a little bit. Although let's look at Market Watch. We see the 2-year down right around 3.6. And we see the 10-year. It's still maintaining that 10 basis point spread roughly. And you can see it really with some volatility based on what Powell is saying, which really surprises me because everything that I heard was dovish. The market obviously interpreted that as a little more hawkish. But for me, that just goes back to what I was saying earlier. And for my personal portfolio, this presents a little bit better opportunity. So on that note, guys, enjoy the rest of your afternoon. Make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.